Your portfolio is bleeding because your brain is lying to you, specifically during your most confident trades. The Dunning-Kruger effect isn't just an academic theory. It is the reason retail traders lose thousands of dollars the moment they feel like experts. It happens in the seconds before a market crash when your certainty peaks and your judgment vanishes. We are going to dismantle this psychological trap that wipes out accounts every single day through three specific steps to fix this. And the final method is something almost nobody in the retail trading community talks about, even though it is the only thing that actually saved my own account. Sit back, grab a cup of water, and let us get to work. The Dunning-Kruger effect is not just some academic theory from 1999. It is a measurable cognitive bias where people with low ability at a task overestimate their competence. In the stock market, this manifests as a dangerous cycle of beginners experiencing early, accidental success, which then leads to a catastrophic sense of invincibility. Ever wonder why the most successful traders you meet are the ones who speak with the most humility? It is because they have survived the exact trap I am describing. Let us start with the first step to beating this, which is the practice of tracking your decision process, not just your profit and loss. Most people obsess over the green or red number on their dashboard. That is a mistake. You need to keep a trade journal where you explicitly write down the hypothesis behind every single move you make. Why are you buying this asset? What specific event needs to happen for you to be proven right? My friend Marcus started doing this in 2021. He was making thousands on meme stocks and thought he was a genius. But when he started journaling his reasons, he realized he had absolutely no thesis. He was just gambling based on social media hype. Once he saw his own lack of logic on paper, he stopped the gambling and started studying value investing. That simple shift in focus from the outcome to the process saved him from the eventual crash that wiped out everyone else in his circle. It is an easy win, but most people refuse to do it because they do not want to see the truth about their own impulsivity. You need to be better than that. Now, here is where things get interesting. And if you are finding this breakdown helpful, hit that subscribe button to keep your mind sharp for the next one. The second point is moving beyond basic journaling into what we call the pre-mortem exercise. This is a high impact strategy that forces you to confront your own bias head on. Before you pull the trigger on any investment, you stop and ask yourself, it is 1 year from now, and this investment has failed completely. What went wrong? Most people cannot answer this because they are blinded by their own confirmation bias. They only seek out information that validates their bullishness. When you perform a pre-mortem, you are literally training your brain to find the blind spots that the Dunning-Kruger effect hides from you. There is a famous study by the CEO of a large financial firm that showed traders who spent 20 minutes doing a pre-mortem before their quarterly strategy meetings outperformed their peers by nearly 12% over a 3-year period. Think about that. 12% is the difference between a good career and a legendary one. You are training your brain to stop looking for reasons why you are right and start looking for the reasons you might be wrong. It is uncomfortable, but it is necessary. Now, I know what you might be thinking. You think you are too smart to fall for this, or you think your experience shields you from cognitive biases. But that thought right there, that is the exact feeling of the Dunning-Kruger effect taking hold. All right, you have survived the first 2 steps and you're already ahead of 99% of the people on your trading app. But now, I want to share the third method, the one I have been saving for you. This is the most counterintuitive approach, yet it works better than the other two combined. It is called radical peer critique. Most traders are lonely. They sit in their offices or at their kitchen tables and make decisions in a total vacuum. Humans are biologically wired to reinforce their own delusions when they are left alone with their thoughts for too long. You need someone who is not afraid to tell you that your investment thesis is garbage. In the world of high-stakes poker, top players have what they call a study group. They review hands together, and they are brutal. There is no sugarcoating. If you played a hand poorly, they call you out. You should be doing this with your portfolio. Find one person who is as invested in the markets as you are, but who has a completely different trading philosophy. If you love growth stocks, find a value investor. If you love technical analysis, find someone who only looks at fundamental data. Once a week, you trade your thesis. You present your upcoming trades to them, and you give them permission to dismantle your arguments. I did this with a trader named Alex in 2022. I thought I had a genius play in the semiconductor sector. Within 5 minutes, he pointed out 3 risks I had completely ignored because I was so focused on the upside potential. I did not make the trade. 2 weeks later, that sector crashed 10%. Had I made that trade, I would have been in the red immediately. That is the power of a second opinion. Let that sink in for a second. That one shift alone, the act of inviting someone else into your mental process, can prevent the kind of catastrophic mistake that takes years to recover from. You are not just getting a critique, you are building an immune system for your portfolio. So there you go. 3 real ways to dismantle the Dunning-Kruger effect in your trading life. You start by journaling your process. You move to the pre-mortem exercise to find your blind spots, and you finish with radical peer critique to keep your ego in check. The last one alone could change your entire financial picture. It moves you from being a lucky participant to being a disciplined, professional trader. If you got value from this, share it with someone who is currently learning the hard way, and subscribe so you do not miss the next deep dive into market psychology. I have a video coming next week on how to analyze market cycles that builds directly on these principles. Take care of your accounts, keep your ego small, and I will see you in the next one.